In this week's video, we'll review historical facts that say gold can be a powerful addition to stocks and bonds.
To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player.
If we were reviewing a 10-year period from investment history and you were told that one investment over that period gained 531%, another investment 116%, and a third 37%, most likely we would all be interested in the investment that made 531%. The chart we were looking at shows the performance of three investments from September of 2001 to August of 2011. 531% is the return over that period in physical gold. This is a mutual fund, long-term treasury bonds. Think of TLT. In the ETF world, gain of 116%. And over that period, the Vanguard Index 500 fund, so think of SPY in the ETF world, was up 37%. Any investment that can outperform stocks and bonds by such a wide margin over a long period of time warrants at least consideration for our portfolios. For someone that's retired or getting ready to retire, a period similar to 2001 to 2011, roughly 10 years, that's a long and important period of time. If we look at a portfolio that invested in 50% bonds and 50% stocks, that 50-50 mixed would have returned roughly 76 to 77% over the period we're studying. If we take the same portfolio and add in physical gold and go 33% stocks, 33% bonds, and 33% gold, the return over this period, obviously a period that's favorable for gold, jumped from 76% to 225%. If we started with 500,000 over this period and we went with the 50-50 split, our 500,000 would have earned 76.5% and been worth 882,000. If we went a third in stocks, bonds, and gold, that same $500,000 would have been worth roughly $1.6 million. The point of the exercise here is not to say gold should be in everyone's portfolio all the time. The point of the exercise is simply to say it is prudent to keep gold on our radar as one of many possible options. In terms of our allocations between stocks, bonds, and gold, and the market model, we're agnostics. We don't care if gold is performing well, bonds, or stocks. We just want to have all the options available to us when we're looking at the hard data. This is a Bloomberg headline from Friday, July 29, 2016. GDP figures were released, came in below expectations, came in at 1.2% growth. The Bloomberg consensus was for 2.5% growth. Given high valuations and the weak economic data on Friday, July 29th, we might think it's a good time to short stocks. Let's see what the hard data says. This is SH in the ETF world. It goes up when the S&P 500 goes down. It's an inverse S&P 500 ETF. This is the ETF here. This is calendar year 2007, where my cursor is. This is a weekly chart. These are moving averages here. This is a full-bore bullish look here in early 2008 for SH, or shorting the S&P 500. This look is bearish for the S&P 500 or risk assets in general. We can see that we have price above all of the moving averages, the fastest moving averages on top, and the slopes of all of the moving averages are positive. Conversely, when the S&P 500 and risk assets started to bottom in early 2009, we get a radically different look here. This is a full-bore bearish look for SH, where the fastest moving average is on the bottom, prices below all of the moving averages, and the slopes of all of the moving averages are now down. This looks quite a bit different than this period here. Therefore, if mathematically it were a favorable time to start shorting stocks from a longer term perspective, looking out weeks, months, and years, we would want the present day chart of SH to look something like this in here. So before we look at the present day, the question we'll really be asking is, does the present day look more like this period here in early 2008 or this period here in mid-2009? The answer is this period here. We have a full-bore bearish look for SH. This looks a lot more like this period here than this period here. And this period here was bullish for the stock market and bullish for risk assets. The weak economic data that was released on Friday, July 29th, also aligns with one of the bullish bullet points that we've been reviewing in recent weeks. Weak economic data gives us a higher probability of friendly central banks that print, buy, and tend to prop up asset prices. We know valuations are high, and we know that economic data tends to be tepid. How important is this bullet point here? And is there anything else in the hard data that aligns with that weekly chart of SH that we just looked at? The answer is yes. This is one of the monthly risk-on, risk-off ratios tracked by the CCM market model. This portion of the chart here is the S&P 500 relative to the VIX Fear Index. This is calendar year 2013 where my cursor is, and much like the stock market, this ratio has been very indecisive over the past several years. And like the stock market, the ratio on a monthly basis just printed a new high above this box here where it's been consolidating for some time. And from a momentum perspective, this is MACD here, and this MACD is tied to this ratio of the S&P 500 to the VIX monthly. This is a bullish momentum crossover here. We dropped a vertical line down here to the S&P 500 over the same period when the bullish moving average crossover came for the ratio. After that, good things happened in the S&P 500. Keep in mind, this is a monthly chart, so this is a multiple month rally here in the S&P 500. Similar situation in 2011. We get the bullish MACD cross here, and after that, I can see that, I can measure it, the model can track it. After that, good things happened in the S&P 500. Does this cross here in the present day mean that the S&P 500 is going to rally as it did in the prior two instances? Absolutely, positively, no. Obviously, this is a small sample size. It simply speaks to momentum, and it speaks to probabilities. The probability of good things happening in risk assets is higher today than it was here, here, or here. How is it possible that the monthly chart of the S&P 500 or risk on relative to the VIX Fear Index or risk off, how is it possible that it just broke out to a new high given all of our concerns? We discussed all of that last week, and at the end of this video, if you didn't see last week's video, we'll show you how to find the explanation of these charts and these bullet points. Remember last week we talked about that bonds, stocks, and gold, all of them were consolidating between 2014 and 2016, 2014, 2016, and all three had recently broken out of these consolidation boxes. What happened, and did the narrative relative to the bullet points that we covered last week, did it still apply to this week? From a price perspective, the answer is yes. These charts here, all three of them are as of July 22nd, a week ago. Over the past 5 trading sessions, TLT gained an additional 2%. SPY was basically flat, but it did finish the week green. And gold, since we covered this chart a week ago, GLD tacked on over 2%. Relatively tepid but positive growth and high debt levels have set up a situation where global central banks have been very, very easy, and they continue to be easy. Let's look at the longer term trends as of July 29th for TLT. This is TLT here in 2007. This is a full bore bullish look on our weekly chart for TLT. In this instance, this strong trend here in defensive and long-term treasury bonds ended up being a bearish signal for stocks. Conversely, in 2009, when TLT's chart shifted from a full-bore bullish look to a full-bore bearish look here, that was a bullish signal for the general stock market. How vulnerable do treasuries or TLT look today? Does the chart look more like this period here or this period here where the moving averages are starting to roll over? When we put the charts side by side, it's relatively easy to see that TLT, as of Friday, July 29th, the weekly chart looks a lot more like this bullish period for TLT and bearish period for the stock market than this period here in 2009. Given the high levels of debt and the friendly central banks, it's not necessarily true anymore when we see a strong trend in long-term treasuries. It's not a given that that's going to be bearish for risk assets, which is one of the reasons why it's important for us to keep our eye on the hard data and these breakouts here and let the hard data, the model, and the trends guide us going forward. Last week we talked about currency wars and currency debasement and the market's fear of future inflation. Let's see how the present day and weekly trends in gold compare to 2 points in history. This is physical gold, $GOLD, as of December 30th, 2011. You can see we go from a full bore bullish look to a full bore bearish look here, telling us that the probability of bad things happening on December 30th, 2011 is quite a bit higher than this period over here. If you've been following the financial markets for a longer period of time, you know that gold had a good run that started in 2001. Here, just the opposite. Here we go from a full bore bullish look to a full bore bearish look. Here we go from a full bore bearish look to a full bore bullish look, telling us that the probability of good things happening here in physical gold was higher. For bullish on gold, we would prefer the present day chart to look more like this chart over here than this chart here. And that's exactly what we have as of Friday, July 28th. Price is above all of the moving averages, the fastest moving averages on top, and the slopes of all of the moving averages are positive. It might be relatively easy to look at the present day chart of gold and saying, well, too bad we missed it. The run in gold is probably over. Let's go back and look. Here, we have hard data in hand that tells us the probability of bad things happening in gold on December 30th, 2011 is now higher than it was here. Conversely, on September 28th, 2001, we have hard evidence in hand that says the probability of good things happening in gold is now higher. Was this signal helpful potentially? And was this signal helpful from a historical perspective? Said another way, was it too late to sell gold here on December 30th, 2011? And was it too late to buy gold on September 28th, 2001? And you'll remember from the opening slide in the video, September 28th, 2001 was the start date of the period that we examined when we looked at gold, the S&P 500, and long-term treasury bonds. We didn't pick that date arbitrarily. It came from this chart here and was based on the look of this chart and the probabilities. In terms of whether or not these signals were helpful, the answer is a definitive yes. After the signals came, this is December here of 2011, and gold did fall for a long period of time, literally a number of years. So the weekly signals were helpful in this case. Here on September 28th, 2001, gold had that full-bore bullish look that we just looked at, and this is September of 2001. Here, was it too late to participate in this historical trend in gold? In this case, the answer was a definitive no. It was an excellent entry point for the yellow metal. Given that we had our full-bore bullish look on the weekly chart for physical gold on September 28th, 2001, how did gold do relative to the S&P 500 after that signal? The answer is here on the left side of your screen. This is physical gold relative to the S&P 500 between September 28th, 2001 and December 30th, 2011. You can see for multiple years here, physical gold significantly outperformed the S&P 500 or the general stock market. Remember, in last week's video, we showed that the S&P 500 did have a retest after that 1994-1995 breakout. It's possible, July 29th, the Dow is retesting this level here. We'll find out over the next few trading days and weeks whether this market passes or fails the retest. As of Friday, July 29th, the Dow was still holding above this level. The same can be said for the S&P 500. Friday, July 29th, it's still holding above the breakout level of 2134. The longer it holds above this level, the more relevant it becomes. Last week we said if the NASDAQ was able to break this downward sloping trend line here, that it might run up to this line here. So far, it's about halfway there. We'll see what happens next week. Friday, July 29th, the NASDAQ is also holding above the New Year's down gap here. The longer it holds above it, the better. Intraday on Friday, July 29th, the broader Wilshire 5000 index was trying to poke its head above this blue line here. Since we're still close to these highs here made in 2015, the jury is still out on whether or not this will be a positive breakout or this will still act as resistance. We'll learn something either way. In the next segment, we're going to be looking at some of the relative charts or ratio charts that we've been reviewing over the past few weeks. But before we do that, remember, we've already established that bonds, stocks, and gold all have bullish trends, and mathematically, the model likes them. A chart like this one, S&P 500, relative to bonds or TLT, helps us with questions like this. Should we sell all of our bonds and go full bore into the stock market? Based on the evidence, the answer is no at this point. Inside the green box here, especially this period here off the Brexit low, the S&P 500 rallied sharply to new highs, exceeded these highs from 2015. The ratio of the S&P 500 to bonds hasn't come close to exceeding the highs from mid-year 2015, and we can see it's still in an established downtrend. That may change, but it hasn't changed yet, and as long as a chart like this looks like this, we would prefer to hold on to some of our bonds. Similar situation here. We get a sharp rally in the S&P 500, but the ratio of the S&P 500 to gold has not even exceeded the high that was made in May of this year. The ratio of materials to bonds, or XLB, relative to TLT helps us with that fear of deflation relative to the fear of future inflation. And a ratio like this also tells us something about economic confidence relative to economic fear. S&P 500, new highs here. These are the exact same time frames. This is August of 2014. This is August of 2014. The S&P 500 has broken out. This ratio here is not even close to the highs that were made in 2015. We'll learn something either way, but right now, this ratio remains in an established downtrend in favor of TLT. That may change, but it hasn't changed yet. Similar story and similar situation when we look at the ratio of XLE or energy stocks to TLT. The ratio last made a high in April of this year, and since then it's been making a series of lower highs and lower lows. It's a daily chart of ACWI. It's a global stock ETF. Resistance, resistance, resistance. We have a bullish breakout here on the daily chart. We also can make a case for an inverse head and shoulders look. This would be the left shoulder, the head, which is lower than the left shoulder, and we've got a more shallow right shoulder here. This would be the neckline. The longer price stays above this neckline, the higher the probability that we get an impressive push above the neckline. This chart shows improving probabilities for global stocks, but we have to keep in mind that ACWI weekly has yet to break out relative to long-term treasuries or TLT. The improving look of ACWI can also be seen on the weekly chart of the broad NYSE composite. This is as of Friday, July 29th. You can also make a case that we have a potentially bullish breakout from an inverse head and shoulders, left shoulder, head, right shoulder, neckline. The longer this market stays above the neckline, the better for the bullish case from a probability perspective. This chart is unquestionably showing some improvement from an asset allocation perspective. We also have to understand that NYSE weekly has not broken out yet relative to TLT. Just updating our weekly chart of silver that we've been covering, the bullish breakout is still holding. On Friday afternoon, SLV was up 3% for the week. Similar situation with gold mining stocks. On Friday afternoon, GDX in the ETF world was up over 5% for the week. And while the currency debasement-friendly precious metal-related investments had a good week, materials weekly as of Friday afternoon was basically treading water near break-even, and the economically sensitive XLB has yet to break out above this downward-sloping weekly trend line. Like some other charts that we've looked at, we'll learn something either way. The same can be said when we look at the daily chart of XLE or energy stocks in isolation. It also has yet to break out. The market will determine in the days, weeks, months, and years ahead whether the bullish breakouts in TLT, SPY, and GLD will hold. But we don't need to know that in advance, because if we keep our eye on the hard data, the rules, the risk-on, risk-off ratios, and the CCM market model, they'll help us stay in the right place if we keep that all-important flexible, unbiased, and open mind. If you missed last week's video, you can find it by Googling this title here. The video covers the bullet points for the charts of TLT, SPY, and GLD. And if simultaneous breakouts in TLT, SPY, and GLD seem confusing, and if the S&P 500 levitating seems confusing, you can Google this title here to gain some insight onto what's driving the markets from a fundamental perspective.
How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.